Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for clicking on here and joining our first Market Carver for June. As we cover a couple of the topics that we had in this week's investment allocation meeting, we'll talk about the dynamics between equities and fixed income. I think we're at a pretty clear and important relationship between the two, and we'll unpack that. And then Andrew will update us on what we see in software stocks. Of course, part of the technology group that is such a big piece of the S&P 500 and very important to the overall market. So let's dig into valuation and the difference between equities and fixed income. Those are the two, by far, biggest choices that investors have. And nearly all portfolios will have some measure of both of them in the portfolio. Equities for their growth and fixed income for the stability and income. But that weighting can change and be dynamic over time as things change. And there's many inputs, but one of those things that change the allocation, particularly for large institutional investors, is valuation or relative value between stocks and bonds. Or put another way, how much return, how much reward can you get for each unit of risk taken? And in treasuries, because you're investing in a real safe not chance of actually losing your principal over a long enough time. That safe investment then has got to be compared to the risky nature of equities, which can at any point in time have bear markets and steep drawdown. So this picture here is showing you on the top panel the S&P 500, and over the past 18 months, it's gone mostly up. And then the bottom panel is the 10-year Treasury bond and its yield over those same 18 months. We have generally drifted higher, but it hasn't been in a straight line. So here's where the relationship has gotten interesting. And before I get there, just one kind of big overarching point, as I think nearly every market strategist would argue in some way, part of the underpinning of what we've seen for pretty strong equities ever since the great financial crisis. Of course, again, not in a straight up line and with its bear markets, but really strong returns for a long period of time, I think has been due to the fact that there has been low interest rates. For nearly a decade, there was an acronym for TINA. There is no alternative, meaning you can't really even get income in short-dated fixed income. But that has begun to change. And over the past 18 months, one of the important relationships has been when the 10-year Treasury has crossed 4.5%. For one reason or the other, that seems to be the point where these investors are finding better relative value in fixed income or not enough return in the equities per unit of risk to kind of offset that risk-taking nature. And you could see that show up in the stocks. In that top panel, you could see there's marked two ways. In blue is when the Treasury yield is below 4.5, and then in red for when it's above. So those up periods have almost been exclusively when Treasury yields have been above 4.5. So we recently again pierced that 4.5 and began to work sideways, at least here for the short term. Now, we wouldn't expect this to be like a permanent dynamic and be this perfect all the time. But for the time being, this appears to be a very clear relationship that matters and something to pay attention to for how much equity risk we want to be taking in portfolios. So that's the stock versus bond dynamic. Andrew, guide us to what you're seeing in software stocks.
Yeah, so often when we talk about the market, we're talking about broad indices. Then sometimes we'll break that down, take a step further, start talking about sectors, technology, financials, industrials. We can even go below that, start to look at sub-industries, and then we start getting into the stock level themselves. And so when we start seeing some different dynamics, we want to understand why are certain sectors or markets performing the way they do. We've often talked on these Market Carver calls and oftentimes in our allocation meeting that what had been driving at one point the market higher was the mega cap stocks, specifically the Mag 7, the Apples, Nvidias, Facebooks of the world. And then we can start looking at, we understand why the market was doing what it's doing. When we go back to 2022, we saw that the market coming into that year was very narrow. We didn't have a lot of stocks participating across most sectors. And so we knew that there was potential for the market to turn lower because we knew what was driving that current trend. And so now we fast forward to today and we look at technology. Again, a sector that's extremely heavily weighted in the S&P, some of the biggest, most growth-oriented stocks. find themselves in the technology sector. Some of the biggest companies in the world are tech stocks. So it's extremely important to understand what's happening in the tech sector. So when we go below the surface of the tech space, we can start looking at the individual components, one of those being software. Now, one of the themes throughout 2024 has been AI. And it's kind of started last year as well. Everyone's talking about AI. What can AI do? It's a lot of companies are talking about it on their conference calls. People buying, or a lot of companies are buying semiconductor chips in expectation that AI is just going to take over the world. And so that really helped propel the expectations for a lot of software companies, as software was going to be able to expand margins, and a high bar was then set for this space. Unfortunately, many of the software names, the stocks themselves, have been unable to be able to keep up in performance. And if we look at the far right side of this chart, on the bottom panel, we have the tech sector. On the top, we have the software industry. We can see that the tech space has continued to go higher for most of 2024. However, when we look below the hood and we look at just software, really since mid to late February, software stocks haven't really been able to do anything. It hasn't been able to keep up with a lot of the tech sector. And so this tells us that it's other parts of the tech space that are driving things higher. But why software is important is because oftentimes software leads the trend for tech. And we saw a great example of this actually going into 2022. If we look to the left of the chart, we can see that software began to turn lower for several weeks while the tech sector was continuing to go higher. But when then software finally kind of broke the camel's back and tech began to roll over. And there was many other dynamics that were going on at that time. But it's just one example where we saw software was a leading barometer, you could say, for the tech space. Does that necessarily mean we're going to see a repeat of 2022? Of course not. Every year has its own dynamics and different headwind, tailwinds that are impacting markets. But this tells us that we want to be cautious towards tech. We could start seeing tech begin to be under pressure as well if we don't see software maybe start to improve, or we start seeing some of those other industries also begin to roll over. Right now, semiconductors, very, very strong. We're still seeing a lot of strength there, and that's what's helping propel the tech sector higher. So knowing that, we want to continue to watch all the different industries for all the different sectors, and that's why this really is a full-time job, understanding how each sector is dynamics, what's driving things higher or lower, and watching for changes in that trend and how they can impact different sectors, and then obviously the broad market, and then use all that data to then hopefully find different opportunities that we can potentially take advantage of. But right now, for this week, we're really honing in on software, seeing how those stocks are kind of under pressure right now, and what that could mean for the tech sector, and then eventually the market as a whole.
Yeah, that's good, Andrew. I just have to correct one thing you said, and that is it's a full-time job. I would argue it's a full-time passion. Yes, you do get a paycheck, but I know you'd be pouring through these no matter what, and that's great when those two things align. And I certainly feel the same way with the stuff that I cover. So no, just a sidebar there as I hear you unpack that. So thank you guys for giving us your time this week. As always, we'll give you a reminder to give us a call. 800-928-4001, or scan the QR code and book it electronically. Thanks again. Have a great weekend.